Investors are asking a question that's becoming harder to ignore. Should I stick with traditional market capitalization ETFs, or is it time to consider equal weight? To answer this, we have to break down how each approach works and look at the pros and cons of each in detail. So, whether you're looking for a long term strategy or thinking about making a tactical shift, given worries over tech valuations or the AI boom, this episode is for you. So, stick with me to learn more. Before we get started, a quick reminder that we're not giving any investment advice or recommendations. Today's episode is all about education. Joining me today is Tony Dong. Tony is a BC-based freelance writer and ETF specialist with his own site that you should definitely check out, etfportfolioblueprint.com, where you can read his insights. Big welcome back to the channel, Tony. It's great to have you back.
It's great to be seen.
Yeah, Tony lives on a farm in rural BC, so he loves to get on the camera as much as possible, right?
Yeah, it's just my way of checking in with what's going on Bay Street.
Well, let's kick things off and get into it, Tony. I want to have you sort of start by breaking down the difference between what we mean when we say market capitalization and equal weighting in ETFs. So start there for us.
Yeah, so market capitalization is simply how many shares a company has floating around. That's its free float multiplied by the share price. So when we talk about a market capitalization index like the S&P 500, what happens is the companies with a bigger market cap, so higher share price and more shares outstanding, get allocated a proportionately higher weight. And that's why when you look at the S&P 500, the top 10 companies or so take up just under half of the portfolio. And you might get a single company like NVIDIA and Microsoft weighing in at 6, 7, 8% of the ETF. And that's simply because their market capitalization is so high. We talk about the $1 trillion club. Well, these big tech giants are a member of that. An equal weighted ETF is much simpler. If you have the S&P 500 index equal weighted, every quarter, each stock in the company, regardless of how big it is or what sector it is going to get rebalanced to 0.2%. And in between these cycles, companies that outperform will rise in weight, but at the next rebalancing cycle, they're going to get cut down. So it can introduce a systematic buy low, sell high methodology, but that doesn't come free, as we'll explore shortly. There's plenty of drawbacks.
Yeah, let's get into some of the pros and cons of a market cap weighted approach as a start here.
It's dirt cheap. It's really simple. It's one of the oldest, the oldest indexing methodology is price weighting, like you saw in the Dow. And that was very simple to do. You could calculate with pen and paper. As indexing technology advanced, market capitalization weighting became even simpler to achieve. And it also introduces a built-in momentum effect. As these companies get bigger, they dominate more of the index. And during a bull market, you can see strong outperformance. Coupled with the fact that you can own the S&P 500 using ZSP for like 9 basis points, that makes it a really hard thing to beat during the good times.
And what about the cons?
Depending during the stage of the market cycle, market cap weighting can result in you being less diversified than you want. So you might think you're buying 500 of the most dominant American companies. Really, over 30% of your holdings are going to be in 10, most of which are from the same sector, technology, or technology adjacent sectors like communications and consumer discretionary. A momentum also works against you on the downside. If you're heavily concentrated in a few companies, well, when these companies' share prices fall, their market capitalization falls, and then they can drag down the index more so. So it's a good thing for people who bought a long time ago, but in today's market where, we've been on a multi-decade US bull run and a handful of magnificent seven companies represent most of the indexes you're familiar with, it can be a little scary to get invested right now.
Yeah, we hear that a lot. Like, was it 35% of the S&P 500 is made up of the Magnificent Seven alone, and this
I
concentration.
actually that's right here. So as of December 31st, I'm working at the quarter end data here. ETF Central shows that the top 15 holdings, not 10, the top 15 in an S&P 500 ETF is 44.93% of the portfolio, with 36% weight in technology, and the next highest you're going to get is 10.9% in financials. So you're less making a bet on the overall strength of the US economy and more on a bet that technology and mega caps will continue to drive that strength.
So, talk to us about some of the market dynamics that might be causing people to consider an equal weight approach in today's environment.
Stretch valuations for sure. One of them I look at is the Shiller cyclically adjusted price to earnings ratio, or CAPE. It measures trailing 10-year price to earnings, and it's kind of a good way to see how overvalued or undervalued the market is. Right now, Shiller CAPE is around 40. To give you a bit of perspective, at the peak of the dot-com bubble, right before it all burst, it was 44. So we are at historically high averages. And there's a lot of arguments out there saying, okay, the AI boom is not like the dot-com bubble. There's actual revenues and stuff. But again, hindsight is 2020. And if you're trying to take risk off the table, now's the time to be aware of it. The other one I like to look at is the Buffett indicator, which measures market capitalization relative to GDP. It's named after everyone's favorite Oracle Omaha Warren Buffett. Right now, the Buffett indicator is at 200%, which is red hot. If you want to interpret that practically, it means U.S. companies have grown to a size that is disproportionate relative to the overall growth of the U.S. economy. So you're paying more for economic growth than what it's actually worth. Now, neither of these measures are perfect, but they're just two sanity checks that I personally like to use before investing in U.S. stocks.
That's awesome, Tony. And I think we need to see both sides of it. So, what are some of the considerations or potential biases that an equal weight approach would introduce that investors should be aware of?
Yeah, so right off the bat, it's going to cost you more. Because if it's an index-based approach, licensing these more specialized indexes is going to cost higher fees. If you look at the dominant U.S.-listed S&P 500 equal weight ETF, it charges 20 basis points or 0.2% a year. You can get S&P 500 exposure market cap weighted for a tenth of that at 0.02 or 2 basis points. So that fee drag is going to compound year after year and be a persistent drag in good and bad markets. The other one is that a tilt towards equal weight introduces what we call two factor tilts. It tilts towards two different types of companies more so than market cap weighted. The first one is size. Equal cap weighting, depending on your benchmark, will usually result in an overweight to mid caps and small caps relative to what they would be in a market cap weighted fund. This can help you in markets where the size premium is making a return. For instance, uh, during the so-called U.S. lost decade from 1999 to 2009, you had better performance for small caps relative to large caps coming out of the dot-com bubble. The other tilt that it can potentially introduce, but to a lesser extent, is value. Now, what we find is that a market cap weighted approach, you get that momentum, you get those mega cap tech stocks, and these are all growth stocks. There's one value stock among the top 10 of the S&P 500 right now, and I would argue that it's Berkshire Hathaway, the only trillion-dollar member club that's not a growth stock. But if you look at an equal weighted fund, because it's completely agnostic to that, you get more exposure inadvertently to value. Now, I say inadvertently because if you want to specifically tilt towards value or size, there are plenty of factor funds that do it. But if you want to keep it simple, capture some incidental exposure, equal weighting has historically been able to achieve some of that.
Talk to us a bit more about the valuation side of that and how equal weight relates to some of these valuation concerns that investors are raising.
Yeah, it's a side product of underweighting these sectors. So I'm looking at the sector differences, sector relative sector weighting differences between equal weight S&P 500 and S&P 500 right now. Equal weight has tech at 15.22, less than half of what normal S&P market cap has at 36%. By inadvertently underweighting these high growth sectors, you are going to get more value exposure. We see that where the equal weight S&P 500 is higher in industrials, financials, healthcare relative to SPY. Not too much, but it's enough to make a slight difference, especially when regimes change. We've been in a very favorable macro environment for growth in large caps recently. Doesn't mean it'll always hold true.
Of course, past performance does not guarantee future results, but talk to us a bit about what historical performance tells us if we look at an equal weight versus market cap approach to the US market, maybe as an example.
Yeah, I have the total return. I have the cumulative returns of the S&P 500 total return index. So that's with distributions reinvested against the S&P 500 equal weight total return index. Importantly, though, I want to preface this is that both of these are indices, not historical funds. So it doesn't show the potential effects of fee drag, which we know are going to be higher for equal weight. But from 1990 to present, the equal weight has outperformed in terms of cumulative returns, but it's come in cycles. For example, from 1997 to 2002, Market cap weighting outperformed on the back of the dot-com bubble. You had giants like Cisco, IBM soaring to the top and driving the index higher and higher. Whereas in an equal weighted S&P 500, every quarter, once they go past their 0.2% allocation, well, it gets trimmed. You get that momentum cut. And that's one of the downsides of an equal weight strategy, where it's a negative loading to momentum, which can work against you. But then after 2002 up until 2009 at the great financial crisis, equal weight strongly outperformed total return. And that's because these large caps started lagging, and the equal weight strategy provided that systematic buy low, sell high effect. And then since then, they've alternated, but so far, based on 1990 to present, equal weight has a cumulative advantage. But I stress again, it's time period specific.
For sure. Now, you have mentioned multiple times that equal weight is more expensive than market cap weight. But we just launched last week ZEQL, our equal weight US equity ETF that tracks the MSCI index at 5 basis points. So same as S&P 500 on our books here. So this is really exciting. We are the cheapest in across North America, even if we look at US listed ETFs, the cheapest option out there. But talk to us a bit more about ZEQL, if you don't mind, Tony.
Yeah, so just right off the bat, the fee is very competitive. A 0.05 for a management fee is highly affordable. That reduces a persistent source of drag year after year. One thing to note is that your benchmark selection will vary. Using MSCI versus S&P, you know, it's like not apples and oranges. It's like Pepsi versus Coca-Cola. Every person has their taste, but they're fine. But one thing I do like to point out is that it's good for tax loss harvesting, because you might have unrealized losses on a older equal weight ETF of a different index, that's not substantially identical to a one using an MSCI index if it's an S&P, and then you could you know, sell one and buy another one within 31 days without running afoul of the superficial loss rule. Again, always check with a financial advisor or a tax professional, but this is just one of the benefits of shopping around for solutions like ZEQL can bring to Canadian investors.
Yeah, very, very similar at the end of the day. I think MSCI has 540 some odd holdings versus 500 in the S&P 500, but yeah, very, very closely aligned there. Thank you so much, Tony, for joining us today and bringing the insights on this. I appreciate you coming back to the channel and hope to have you back again soon. Um, Thanks to our listeners for tuning in. That's all for this week, and we'll see you next time. Bye for now.
My pleasure. Have a good day.